Welcome, everyone. Nice to see everyone. Thanks for coming. Some of you know Scott Gilmore. For those of you that don't, Scott's a wonderful partner of ours. Scott is the CEO of Ascend Partners, and we partnered with Scott for a number of years on the tax side. Scott, you've picked an interesting profession. In many ways, it's a thankless profession, taxes, right? Taxes are often not considered a lot of fun. I think the common phrase you've heard a lot of time, I think it's attributed to Benjamin Franklin, is something to the effect of the only thing that's certain in life are death and taxes. Yeah, you probably heard something like that a number of times. And it's understandable. What's that?
Good for job security.
Right, totally. And it's understandable. Taxes can be frustrating, right? We all have the challenge of filing our taxes, sending our CPA a bunch of tax forms, meeting a deadline, and it feels just very sort of reactive, and then you wait for the check that you ultimately have to write to the government. It's just not a fun experience. And that takes us to our relationship with Scott and his team and advisors. It's a very different approach. It's not a reactive approach, but I think something that Scott and his team do very well. It's a much more proactive approach where he's really a strategist. He strategizes with us and the clients we work with, and we're going to talk about some of those strategies today. But a lot of it's on spotting planning opportunities in ways that you can minimize taxes, and things around maybe identifying more efficient ways to structure something, maybe whether it's something as simple as a retirement plan or some sort of business structure. And we're going to hit on a handful of those things today. We're going to make it very interactive, so we'll ask questions along the way. But before we do that, I wanted to just for everyone to get to know Scott quickly. If you don't mind, Scott, just give a little bit of your background, where you grew up, where you went to school, talk about your family.
You got it. Well, first of all, thank you, Jeff, for having me. Thank you to Morton Wealth. Like Jeff mentioned, I've been working with the great folks over here. God, it's probably been 8-9 years by now. A third firm, finally, our own home. Our firm is now located actually just across the road on Agora Road. We just opened a new firm earlier this year called Ascend Advisors. It's a group of folks that I've been with since I started my career in 2004. So I have some longtime friends and colleagues that are now my partners, and we're really excited for this partnership. A little bit about myself. I am a born and raised LA native. I was born in the Valley in Woodland Hills, went to school there, grew up there.
Where did you go to high school again?
El Camino.
That's right. I went to Taft.
There you go. So
Rivals.
we were rivals back in that time. Did not venture, I won't go through the whole story. We only have a certain amount of time, but graduated from UCLA, didn't travel too far away from that. Ended up getting a master's in tax from CSUN when they brought back the program in 2006. And now I live out here in the Conejo Valley. So close to home. This is what I know. I have a wife and 2 kids, 10-year-old girl and an 8-year-old boy that keep me very busy. We are an avid sports family, so oftentimes I am out coaching baseball, football, basketball. That's how we like to spend our free time. So when we're not working or planning opportunities or dealing with people's tax lives, we like to deal with the sports world, which is fun. So, but this is home, and very much love being in this beautiful area.
And as you can all imagine, the tax profession, the hours, especially during certain times of the year, get very challenging.
Yeah.
And the long hours you work around those certain deadlines. But even with those deadlines, I know you've like coaching your son's baseball is a big
Yep.
hobby of yours, and then you log back on, and I see you on until midnight, some late nights dealing with taxes. So it's a challenging schedule.
The beauty of technology today is, though, you can work from anywhere, and you can kind of make your schedule what you need it to be. So with good planning, no different than if you're a financial plan, a tax plan, or just a life plan, good enough planning, you can find ways to get the different things you need to get done. Yep. into that. And it's a different world than, say, our parents grew up in. And my kids don't I went back after COVID, I started going back to the office more often, and they're like, well, what are you doing, Dad? It's like, well, this is kind of how it usually works. So.
All right, so we're just going to dive into it. We have about 4 or 5 planned broad topics that we'll talk about. And I'll pause during each topic. We'll open it up to Q&A. And then we'll go on to the next topic, and we'll definitely try and save time at the end for questions as well, because some of you might have miscellaneous questions that we haven't thought of. I'm just going to quickly start with the current environment we're currently in, specifically in California, and just the simple fact that for the weird aspects I mentioned about the storms, because of the storms, we don't have to file taxes by April 15th. So can you just talk about a little bit of the logistics around that, and then potentially the planning opportunities that arise because of that?
Sure. So are you guys all aware that 415 for us here in LA and Ventura County is a non-factor this year? Yay, right? Really strange. So originally they made it in January, they made the deadline 515. Then we got another round of storms earlier in March, and they said, hey guys, you all get till 10/15 to file your taxes, to pay any of your taxes. And we're like, wait, what? This is very abnormal, obviously. So here's where it lays right now. For most counties in California, I think there's 3 counties in California that don't qualify. They're all up north, so they're not impacting any of us per se. You have till 10/15 for legitimately everything. And by everything I mean to file business taxes, to file personal taxes, partnerships, corps, individuals, trusts. And you also have till 10/15 to make any type of payments. So whether you owe money for 2022 or you pay quarterly estimates for 2023, none of that is due till 10/15, right? And so that is a very interesting, and that you're not hearing a lot about this because it really is centered around just here in California. So it's not a nationwide thing, even though this extension came down from the IRS and California agreed to it. It was not a California-driven extension.
I was looking at that, surprised me. So this was actually driven by the federal government, not by Newsom? Okay.
Newsom had to actually conform to it. The federal government declared it a disaster area and gave this extension.
Okay.
And so the first question, everyone's like, well, does California agree? Because California is known in general not to agree to a lot of federal rules, right? Taxes over the last 5 years, they've changed God knows how many times. California, no, like that one. Yeah, we'll conform to that. No, we're not going to conform to that. And so they make it so that now you truly are filing 2 different tax returns. It's not just a piggyback, it's 2 different sets of rules at times. But the most interesting opportunity that I see out of all of this is some of us might have had a big event in 2022, sold a business, sold a home, a lot of different things could happen, right? Got to pay that estimate by January 15th, or I'm penalty proof and now I got to pay by April 15th. No, you don't. You can pay on October. So all of a sudden now, that money market account or that treasury account or that, I leave it to the financial advisor to tell you exactly, but there's actually a return on your money in the bank right now, if the bank is all functioning, of course. But you actually, by holding on to your money, if it's a significant amount of money, you can get a real return. There's real money to be made between April and October. That's 6 months of earnings that you can make that otherwise you would need to pay the federal government. Same thing, high net worth, high earner, you got to pay quarterly estimates. You can hold back all that money in a safe, secure investment strategy and know, hey, I'm going to have a big tax bill come 10/15, but I can maximize my earnings on that money for the time being. And so that's something that we're working on a lot of our clients with, just to say, hey, how can this extension be a benefit? You're still going to pay the tax, but you can actually, it can feel a little bit better if actually that money went to work for you for a little longer.
These are real dollar and cents here. So typically in a 0 interest rate environment, up until the last year or so, it just made sense. Pay your quarterly payment. Why hold on to the cash? There wasn't value in holding on to cash. The landscapes change. As you know, we talked about it on Morton Wealth webinars, et cetera, and in your portfolios. All of a sudden, fixed income, some simple bond investments, you can earn in really risk-free money markets even, you can earn a few percent. So to Scott's point, instead of even making those quarterly estimates or balance dues, et cetera, just invest in it. We can obviously help you with some of those strategies as well. It has to be there. You ultimately have to pay it come October. But you can make real money over that 6-ish month period. One other follow-up to that, and it's a little bit nuanced. It might not pertain to many in this room, but it is an important nuance. 1031 exchanges.
Yeah.
1031 exchanges, if you can quickly explain what they are, but related to this rule, how also the government buys you more time with regards to 1031s.
So just as a general point, I deal a lot in the real estate world, right? Being here in LA, there's a lot of real estate investments and people in that business, so I do a lot of work there. So the 1031 rules, which is where you can sell a property, take the money, buy another property, and not pay taxes. Yes, I'm generalizing it, but that's essentially how it works. There are, in order to execute on that transaction, there are certain deadlines. There's a 45-day window where you have to identify your new property, and you have to close within 180 days or 6 months. Well, this rule just made it so that if your 45-day or 180-day mark comes before 10/15, don't worry about it. We're making it 10/15 now. So you literally have 10 months to exchange your property under this rule. Can't find most people when they're doing 1031, looking for something, I got this window, I've got to close on it. You have this great time to extend. The money's sitting at the accommodator making interest for you, so it's not like you're losing out. So the ability to close your 1031s or conduct a 1031 exchange has now really got spread out, because you may sell your property, let's say you sold it in January. You don't need to find that new property for 10 months till October. So that's another good little, for people that dabble in the real estate world, that's a little advantage there.
Yeah, 1031 is a very powerful tax deferral strategy, but it's restrictive. You have true time constraints. This has really drastically opened up the time constraints around 1031s. So before we jump into the next topic, does anyone have any follow-up questions or clarifications on any of this?
California taxes follow on that.
Absolutely, yeah. What you do have to be aware of is if you owe taxes out of state, those are not extended, right? Those payments do need to be made. And if somebody obviously doesn't live, the IRS is going off of the address. So if you don't live in a covered county here in California, all of this does not apply to you either. But yes, California taxes as well.
So when the first delay, maybe the 1 month delay was announced, it made it sound like you had to prove you were directly impacted by personal disaster.
Right.
And so apparently now it's just everybody across the board.
It's across the board, yeah. And
You live in Santa Barbara County.
correct. If you live in a covered county, you automatically qualify for the relief. And there's a lot of people that it was a nice benefit because the impact was maybe minimal for them.
You just saved my month looking into next month.
That's great.
Everyone go on vacation in April, right? Yeah.
And again, to clarify also, you don't even have to file an extension.
Right.
I mean, there's
It's
not even
automatic.
necessary to file an extension. Any other questions on that?
So if you normally pay quarterly, first and second quarter won't be due till third quarter.
And even third quarter is a month behind because third quarter is usually 9/15.
Right.
All three of those are now 10/15.
So you just pay them all at that time.
Yes.
I'm all at that time. Does this make your life easier with the April 15 deadline?
It's a pro and a con. It really is, because we still have a lot of folks who want their investment K1s done early, and that's a big piece of our business, so we still need to do that work. It's great that come 4/15, we don't need to make sure everyone's paid their balances due. That's the one advantage. The disadvantage is, as a business owner, you hire and staff up according to supply and demand, right? Very basic principles here. So we're all geared up to do all this work this first quarter, and this kind of delayed that. So it's a pro and a con, but hopefully more of a pro with some good planning and that type of stuff.
All right, so we'll move on to the next topic. I want to talk about, some of you might have heard of the term AB 150. It's an interesting nuance in California law. It's related to state tax deductions. So by way of reminder, this was pre-2018. Your California state tax, up to certain limits and restrictions, but basically can be largely deductible on your federal tax return. The 2018 tax law really changed that drastically and really limited it meaningfully. But then in the ensuing years, and I don't know if it was 2019 or 2020, for certain tax filers, this new rule, AB 150 in California, came into play, where there are some still abilities to have state tax deductions, California state tax deductions on your federal tax return.
Yes.
Can you describe a little bit of the history of it and then explain who this applies to?
Sure. So a lot of different states are doing this, right? Tax law, it gets more complicated the more different rules you have to deal with. And so I don't know the exact count, but I think 40 of the states have now come up with some type of what we call PTE, pass-through tax exemption. California, AB 150 is a assembly bill. That's the assembly bill number. That's where it comes from. That passed this law. We'll focus on the California rule because I haven't kept up on all 40 states, unfortunately. But like as Jeff mentioned, before 2018, you could deduct state taxes paid as an itemized deduction on Schedule A. Now, a lot of us would have alternative minimum tax and we wouldn't be able to deduct it, and some things might have happened. But letter of the law, it was deductible. 2018 tax law, they now cap that at $10,000. Well, for any of us that are homeowners in any recent time, we hit $10,000 by just paying our property taxes. So essentially, our state taxes became non-deductible completely. We were getting zero benefit out of it. So this rule came in, I believe 2020 was the first year it came in. And it says for owners of pass-through entities. What's a pass-through entity? An LLC or an S-Corp, for argument's sake. Those are the two entities where this really works. You can pay your taxes related to the income of that company, that LLC or that S-Corp, at the S-Corp or LLC level, and that company can deduct that payment. That payment then comes through to you as a credit on your personal tax return on your K-1. So by way of example, the way California does it, it's a 9.3% tax. Okay, that's standard, that's set. You have to pay 9.3%. Let's just use high numbers because I think it gives a lot of quantification. $1 million of taxable income. Now your tax rate is going to be 13.3% in California, but you're going to withhold, in this case, $93,000, right? 9.3% of $1 million. You're going to get a $93,000 federal deduction, okay? Federal tax rate, top rate's 37%. So let's just say you're getting a $35,000 real dollar value out of doing this AB 150 payment. So your company makes the payment that you would have otherwise made individually. It's going to be made either which way. And now you've got a deduction that equates to $35,000 more dollars in your pocket. If you have multiple entities, you can do this as many times as you want. And what we do is we look and we do estimates at the end of the year, and we pay in our AB 150 payments by the end of the calendar year. So we did this for 2022. We had everybody try to pay in their AB 150s by the end of 22, get that deduction, and just maximize our tax savings. It's called the SALT workaround. If you guys have heard that term in the news, it's a similar SALT, state and local tax. This is a workaround to try to allow state taxes to still be deductible because this impacts people in high tax states. Hey, California's still the winner on that one. Helps people in these high tax states to minimize their overall tax burdens.
So this does not apply, generally speaking, to most individuals. Again, it applies to pass-throughs.
Yes.
But can you talk about that a little bit more? Because there's some very simple pass-throughs that individuals might have. Maybe it's a simple LLC, running a side business. Maybe it's owning a piece of real estate. And so how you can, for single-member LLCs, you can
become eligible.
Exactly.
Yeah. So this can impact everybody in the room to some degree. For the business owner that's operating a company, it's pretty straightforward. You're going to make the election in your LLC or S Corp. But as an investor, you could have a real estate deal. You could be a passive investor in a restaurant, another business where you get a K-1, and that business can make this election to get a deduction. So on even the most simplistic, let's just say you own a rental property and you formed an LLC for liability protection. You own your rental property, you and your spouse in an LLC. That's considered a single member LLC, only one owner. And so you don't file and get a K-1, you put it on your individual return. But you have the option to either file you and your spouse as a two-member LLC, or as part of a bigger planning strategy, you could bring in a second partner. Could be a child, could be a sibling, could be as simple as a 1% owner. That takes your single member LLC, makes it a multi-member.
Because these single member LLCs are not eligible.
They are
correct?
not eligible, right? You have to get a K-1 for this to be eligible, and a single member does not issue a K-1. You got to get a K-1. So you find ways to turn these single member LLCs into multiple member LLCs. Now everyone gets a K-1, and you can now do this AB 150 deduction. So even if you own one simple rental property in an LLC, this can give you a little bit of tax savings.
So you can, for instance, even, let's say, gift a very small percentage to one of your kids.
Absolutely.
Maybe it's a 2% interest. That would then make you eligible to take advantage of this deduction.
Right, and it's a double win, right? Because when you do it in conjunction with a bigger plan, estate planning, you gift 1 or 2% to a kid. Well, you're going to get a valuation discount on that property. So you've already given it to your kid for less than it actually is worth. You're going to pass any appreciation out of your estate. So it's a good strategy absent of AB 150. Now you're going to put a tax savings on top of it. So it's kind of a win across the board. And so there's various levels that this can impact you at, but it's definitely something that you want to be aware of and make sure you're not missing opportunities. It's only 2021 was the first year or 2020 was the first year you could do it. 2023 was the third. It's a very new strategy, and so it's not on everyone's radar. One other thing that I will mention is that the way the law was written, AB 150, is if the federal government changes the rules and the state and local tax becomes deductible again, this law goes away automatically. So there is that trigger in there. There's also, it's technically right now set to sunset or go away in 2025, which is also the year that the 2018 tax laws are supposed to sunset as well. That was done strategically. So this is only technically around for 3 more years, but it'll be interesting to see what future laws are going to bring and whether or not this becomes permanent or whether or not the SALT deduction comes in and then every state can not have their own rules and it can be a little more unified.
And I'm sure most individuals in this room have tax preparers who are located in California, but I would imagine if you happen to have a tax preparer who's outside of California, this could potentially get missed.
In fact, great point. And yes, I have seen a couple of clients who have come to us this year who are here locally, but they've been using out-of-state preparers, and they're not aware of this rule. On the flip side, right, we have to be fair here. I have some few clients in New York, and they have another rule. And we were made sure to get on top of those New York rules and understand them because there's deadlines. And if you miss a deadline, it's like, nope, you're out. You can't make the election. It's kind of, there's no extension. There's no, hey, forgive me, IRS. Nope, that doesn't exist here. And so it works both ways. Out-of-state people don't necessarily know the nuances of the California rule. And there's a lot of California CPAs who may not know the rules of all the other states. And that's why I mentioned that there's 40 different regimens that this SALT deduction can run through.
Complications of the tax code. It's unbelievable.
Yeah, I mean, it's just having a great, got to know a lot of people because it can be so specific to the location that you're in.
Before we move on to the next topic, any questions on this? Yeah.
Yeah, so I have a single owner LLC that pays dividends to an S corp.
The single owner is the S corp.
Well, the owner of the S corp is a single owner, but the LLC is a single member LLC. So
Right.
Does this
The S corp can make
Scott,
the
can you
election.
repeat the question?
make the deduction?
Yeah, so
Just for the purpose of can you repeat
so
the
if I
question?
understand the structure correctly, I think the LLC is owned by the S corp.
Yes.
Yeah, so the S corp is the single owner. The LLC, because it only has one owner, is not eligible. But the S corp, who is the ultimate owner, is eligible. So you can roll that LLC income up into the S corp and pay it at the S corp level.
Okay.
Make the election there. Yeah, so oftentimes partnerships own partnerships, right? You have tiered structures, as we call them. The lowest tier that has the individual owners can make the election and have the rest of that flow in. So anybody who's got any type of LLC structure that issues a K-1 can take advantage of this. You've just sometimes got to work your way through the org chart and the structure to make it work.
Go ahead.
If you have real estate in a family trust, is there a way to do this conversion?
So real estate in a family trust.
Yeah,
In the trust?
so it's a trust that owns the real estate. You would need to create an entity that would be owned by the trust, is how you would take advantage of this.
Layer.
Essentially, yes. But you've got, depending on what, every trusts are very complicated in that each has nuances, right? And so what kind of trust, how does this work? The best way to think about it is property and LLC owned by the trust, economically same owners, but you can still take advantage of this deduction.
Any other questions on this topic?
Just curiosity, how many people had heard about this AB 150? Was this something? No, which is one of the best savings measures out there right now, honestly.
All right, let's kind of dovetail in a similar topic. Let's talk more generally about write-offs.
Sure.
We all are looking to maximize write-offs. The biggest opportunity tends to be for business owners or entities in general. So I'd love your thoughts around how you think about, there's a continuum, right? Whether being conservative on the one end, too aggressive on the other, how you think about strategizing around write-offs. And then we'll talk about at the individual level where other more investment related write-offs are available.
Sure. So the first thing that I think it's important for everybody just to have this background. Right, wrong, or indifferent, the tax code is written to favor business owners. It just is. I mean, I wish I wrote it, I didn't, but if you were a W-2 employee getting a paycheck, especially after 2018 where they got rid of the itemized deductions, you really can't write anything off. Your W-2 is your W-2. So if your company is not covering your business expenses, you don't have a place to even write it off. There's not even a form or a way that no matter the legitimacy of the expense, it's not a write-off, okay? As a business owner, all of a sudden you get this big opportunity to write off expenses. And people say, hey, Scott, well, just tell me what's deductible. And I laugh and I say, well, tell me about your business. Because every business is unique, right? And so I ask them one question. Did you incur that expense to try to generate a profit in your business? And if the answer is yes, and that can be a very gray, open area, obviously, then you have an argument to maybe have a business expense. And if it's like, no, it's because my son wanted a new pair of shoes, that's probably not a business expense. And so as you think about this globally, think about to yourself, what is a business? A business is something you have a profit motive, because one thing the IRS is always looking at, is that a hobby, is that a business? Horses, collectible cards. It's a real business for some people, but for other people it's a hobby. And so the IRS does look at these things, and if it's a hobby, you are not allowed to take losses. You have to report all your income, of course, but you're not allowed to take a loss. And so the distinction is very important. And so when you look at expenses, I tell people the same thing. Was that expense done because you're trying to help create profit in your business? And that makes things like cars and cell phones and subscriptions and newspapers and all kinds of things that I bet you're going to have, whether or not you have a business, deductible. The biggest thing you see nowadays, right? Work from home, remote work, home office, W-2 employee, nothing. It's not fair, but it is what it is. You are not able to deduct any type of home office as an employee. As a business owner, yeah, utilities, internet. Maybe you have some type of office rent agreement with your business where there's a rent payment that's taking place. All of a sudden, your Time Warner cable bill or Spectrum or whatever it might be, well, you need the internet to work, so that's a write-off. So that's really how I like to analyze, is it a business expense? Now everyone, aggressive and conservative, right? That's a personal choice. Some people like to get really aggressive with their write-offs. Some people are like, you know what, my worst nightmare is that letter from the IRS. I don't want to do that. We work with our clients to understand. I say, where's your line? And I take my pencil and I say, tell me how close to this line you want to be. And we tailor our strategies for our clients based on it. And some want to put their toe on the line and some want nothing to do with it. And when the client says they want to go the other side of the line, I tell them they probably should find another CPA because that's not how we do things. But that's the strategy that we like to use.
And we'll talk about business owners in a sec, but related to how close to the line or not you get, can you talk a little bit about your experience with auditors and that comes into play as well, right?
I mean, one of the advantages of having a CPA or an accountant as one of your advisors is I know what the IRS is looking for. Not every auditor is the same. Honestly, it depends if they had a good morning or a bad morning. You never know what you're going to get. I mean, they come from different places. Sometimes it's phone, sometimes it's in person. But in general, we always feel like we have a strategic advantage over the auditors. And I've been in enough audits to know what they're going to look for, what's going to raise eyebrows, and what, might be able to kind of slide under the radar, I'll call it. And so having that experience helps you know when you're advising a client on what a strategy is that's too aggressive and what a strategy is that could pass the test. At the end of the day, burden of proof is always on the taxpayer. The IRS has to prove nothing. They can say, nope, that's not a deduction. Why? Because I don't think it is. And then you've got to prove why they're wrong, not them prove why you're wrong. And so I always think in my own head, what's the story I'm going to tell the auditor with regard to that transaction or that deduction? Can I stand in front of the auditor with a straight face and feel good about that? And if I can, I tell the client, no, we're not going to go there. And so that's really what goes through our head as a practitioner when we're trying to figure out whether or not we should deduct something.
Let's talk about non-business owners. Where are the opportunities for write-offs with non-business owners?
It's post 2018, right? Going back to the tax law that was passed at the end of 2018, it got a lot harder because investment expenses that used to be what we called 2% itemized deductions on Schedule A went away, right? And so, fees that you were paying and things of that nature didn't ever give a great write-off, but it was still just that much more complex. And so what I tell people is you want to try to match your investments, okay? Investment interest expense is still a deduction. So if you borrowed to create funds to make investments, make sure you're writing off that interest. Make sure you're timing it up. That could be money from your home, it could be money from your business, it could be money against your brokerage account, right? There can be a lot of different ways that you take money and invest in another opportunity that creates write-off. More importantly, I tell people the matching thing. It's passive and active. And so I don't want to get too overly technical, but income comes in 3 buckets: passive, active, and portfolio. Passive is I'm investing in a real estate deal, but somebody else is running it. I'm an investor. Active is the business you're working in. Portfolio is interest, dividends, capital gains from stocks and bonds.
Where do the K1, the partnerships we invest fit in? Is it passive or portfolio?
They're both, actually, because some of them are portfolio. If you're getting interest or dividends, it's portfolio. But if you're in one of the real estate deals, it's passive. Or one of the healthcare deals, that could be passive, right? There's so many different ones. And so what you want to avoid it, and I don't know how many people have heard this, I'm going to invest in a real estate deal, it's going to get me a loss, and it's going to offset my income. No, it's not. Why? Because that's a passive loss. And that passive loss cannot offset portfolio or active income. So if you have all this dividends and interest that you're creating because you've got a good portfolio, and then you have a real estate deal that's kicking off a loss, those things are never going to cross each other until you sell that real estate deal and that loss gets freed up. So it's important that you work with your advisors to match active income against active income, passive against passive, and portfolio, and maximize your portfolio deductions. Or if you have a lot of portfolio income, people talk about loss harvesting, capital loss harvesting. It's even more important because capital losses can help with that real estate deal. That real estate deal gets sold, it can free up losses to offset capital gains. The way that they all work together is very nuanced, and you need to have a plan. And so as an investor, it's important that you're able to look at your income in the 3 buckets and make sure there's not something you can do to reclass that income from active to passive, maybe passive to active, or from portfolio to passive, to better generate tax techniques. I've seen returns where so-and-so owes $50,000 and I'm going to input a capital gain right now, more income, but because they had all these suspended passive losses, their tax actually went down. So it kind of defies logic in a way. It just involves planning.
So this very interesting, right? But complicated.
Yeah.
Can probably overwhelm people and be like, I don't
can't
know
do
how
it
to.
without my computer. That's for
I guess that's the question I'm asking. Like, is this you're being thoughtful and proactive when you see an individual's return and looking at these different buckets and spotting potentially where opportunities are or where things can work together?
Whether it's a current client or a prospect, first thing, let me take a look at your return, right, for a multitude of reasons. Where's the opportunities? And I'm looking to try to bucket their income. Where is it coming from? They get a W-2, I just say, man, they're not going to like what I have to say about this. But if I see a lot of passive income, I say, okay, we can do something about this. Or if I see if I see passive income, I look at them, I go buy a real estate deal. Not just to do it, right? But because usually real estate can generate the most losses early on, right? It's just it's analyzing the return, analyzing where your tax is coming from, and then saying, okay, how can I get losses into that bucket? And so if you're meeting with your advisor, whether it be your wealth advisor or your CPA at least once a year, do an overview of your return and say, okay, where was the tax generated and what opportunities do I have to minimize that tax? Why not minimizing the value of the asset that's generating the income?
Let's pause there. Do people, lot covered on the write-off section. Any questions on this topic?
Pretty technical.
Golf membership?
Great question. So I can tell you how we treat it, right? Your country club dues are never a deduction. Your food, yes, sure. You know, if you're taking, but part of the 2018 tax law, unfortunately, it got rid of entertainment. Entertainment used to be just like food. You could write off 50%. 50% deductible, 50% non-deductible. The 2018 tax law said entertainment non-deductible. Golf, concerts, sporting events, all that stuff that all the big companies were doing to entertain, well, they all still do it now. They just don't get to write it off anymore. But as a general rule, the actual dues paid monthly, we never deduct that. And the main reason why, A, you're not supposed to, but B, if an auditor ever comes to me and says, gee, let me see what kind of stuff you're running through here, I go, here's the country club. It's not deductible. And we use that to try to say, hey, look, we're fair, we're honest, and because I guarantee you if the auditor sees your country club's being deducted, they're going to wonder what else is going through there. That's just the easiest way to say this is a good person to dig in deeper on, and you don't want that.
So I have some clients who file jointly as a household, but one might be a W-2 earner, one might be a business owner.
Right.
When it comes to things like writing off in circumstances like that, is that then applied to who is the primary filer?
Can you repeat, Scott?
Yeah, so the question is if you have a married couple filing jointly, and one is a W-2 employee and the other is the business owner, how do those intersect together? And the answer is it's a joint return. And so the business owner can show a loss, and that can actually offset the W-2 because at the end of the day, this return is filed as one. One thing I want to be careful about, right, is if only one person's truly working in the business owner, is only one spouse, it's very easy to take the other spouse's stuff and bring it on in. Yeah, let's write it all off. Be careful. There are rules against that. There does have to be business purpose. And so you just want to make sure that you're respecting that line wherever you decide it may be and not trying to take both spouses and run them through one business when only one person's truly working in the business. Because when the other person has a W-2 and a full-time job, that's a really tough argument to make in front of the IRS that this person's also working in this business. Because unless you're working 80 hours a week, that's pretty hard to have happen.
Other questions on write-offs? Related to write-offs, one of the biggest opportunities for write-offs are with regards to charitable donations.
Yes.
Can you talk a little bit about charitable donations, when they come into play from a tax point of view, and vehicles that are potentially most efficient?
Sure. I think there's two things that are very important about charitable donations, right? On the surface, we all know that charitable donations in the IRC or the tax code are kind of a cherished thing. They very oftentimes are not challenged. They're not looking to be excluded. In fact, sometimes there's limitations. Your charitable deductions can only be a certain percentage of your income, and they actually look to up that percentage at times because they want to encourage charitable activity. There's two parts of the code that I think are really important when it comes to charitable activity to take advantage of. One is what I call, I don't know how many really good loopholes are left out there, but there's one really good one, and that's the donation of appreciated stock, okay? You can buy a stock for $5. It goes up to 50. You have, let's just use one share, make it real simple. If you donate that share worth $50, even though you only paid $5 for it, you get a $50 donation write-off. You get credit for the full value of the stock. That's not true of any other asset. It's only stock. You do it with a car, you do it with a home. People don't donate homes, I understand, but just as an example, this is only true of publicly traded listed securities. You donate them, your write-off is equal to the fair market value of that stock, irrespective of what your purchase price was. So that can make your dollar go pretty far. It's like, oh, I'll sell it and give cash. Well, you sell it, you pay tax, you have less cash to give to the charity. Just give the charity the stock. You get a better donation and they get more money. It's a win for both sides.
So I want to repeat just that last point, just so everyone's clear. In that $50 example, if you sold that $50 stock, you would pay a lot of taxes because you have a $45 gain. You won't have $50 in your pocket to give to the charity. Instead of selling the stock, you just donate the full $50, the full appreciated stock,
Right.
even with that embedded gain.
Correct. And the charity can go ahead and turn it into cash just as easily as you could, and they're very thankful for your donation.
It's very common, even for those who just do small little donations, just because it's so simple to do it with cash. This is a very simple strategy to focus on appreciated stock, because you really are getting a bigger bang for your buck in so many ways.
A lot of my clients, the kids go to some private institution, high school, and you're funding money every year. They give stock every year as opposed to cash, and that's a way they've really kept the schools up and running and going well. The second thing that's important to remember is what's called a DAF, which is short for a donor advised fund. And the reason these things are important is a donor advised fund is where you can put an amount of money in today, okay? And usually you'll see it happen when people have a big income event. You sold a business, sold a house, got some stock options granted, and you have a big tax bill coming, right? So you, instead of giving that favorite charity $1,000, you want to give them more. But charities don't want charities want consistent cash flow. Charities want to know that that money's coming in every single year. And so with a donor advised fund, you can make that contribution today. You have that big income event, you want that big write-off. Make that donation today, get that write-off. The donor advised fund is run by a Fidelity or a Schwab, or one of the custodians holds that money, and then you're able to tell them when to actually give it to the charity. You give, just say, big number, give $1 million to a donor advised fund, get your $1 million deduction this year, but then tell the DAF, every year I want you to give this charity $50,000. So now every year that charity's getting $50,000, helps them with their budgeting, helps them with their operations.
And in the meantime, it's invested, right? Yes. And compounding and growing.
Growing, tax-free.
Tax-free.
Money goes to the charity. And you got your write-off when you needed it the most because you were in the top bracket and you had a big income year. So it's a good strategy to keep the important charity in the situation they want to be in and give you the tax benefit that you're looking for.
Yeah, so this is very powerful, obviously, like you said, if you have a big tax year. But even as you're looking at tax brackets, if you're in a high tax bracket and X amount of dollars would bring you down to maybe that next tax bracket, that would potentially be a year where you would move more into a donor advised fund than you otherwise would,
right,
to take advantage of that deduction at that higher tax rate. And then again, it's in there, and you're not forced to give it away to charity in that year. You can spread that out over a number of years.
And you can give it to any charity. As long as it's a qualified 501c3, you can give it to any charity. Mm-hmm. And oftentimes, guess what? People put appreciated stock into the DAF.
Right.
And now it's a double win, right? And that's, you can either sell the stock in the DAF and reinvest it in something more conservative, or you can continue to hold the security to then give to the charity. So a lot of different ways you can use that to your advantage. Why not? But not harming, but not disrupting the budgetary things that go into a nonprofit situation.
These are really wonderful vehicles, and they're super simple to set up.
Yeah.
Just as simple as setting up a normal brokerage account. They function very similar to a family foundation, for very wealthy individuals who form charitable foundations. These DAFs are actually very similar in terms of how they're structured, provide very similar attributes in terms of flexibility, but they're so easy to administer. I mean, I know some of you in this room have these vehicles, and they're just as simple as almost running a brokerage account.
Absolutely. Remember, if you donate something over $5,000 that's not a publicly traded security, you have to get it appraised. There's a lot of rules that go into charitable giving that need to be crossed. The DAF is a simplified way to reach your goals without the headache of having to go through an appraisal or whatever other nuances go with it.
Any questions on Charitable?
So you set up the DAF yourself, and you give to the DAF, and you get the deduction, and then you determine when it goes out to the charity, and/or which charity can go to.
Correct.
Is that how I understand it?
Correct. Obviously, it's got to be a qualified charity. There's a couple little nuances, but big picture surface, you've got it. You've got it.
Are there any limits?
Are there any limits on the DAF was the question, sir?
The limit to the DAF is the same limit as any charitable donation, right? Right now it's 60% of your adjusted gross income. That same limitation applies, but nothing extra.
Are there time limits for when the money has to be given to the charity?
time limits on when the money has to be given to a charity?
It's a great question. I am not sure because from my angle, once it goes into the DAF, we've realized our tax realization event.
Right.
And so I don't think it can just sit there forever. Do I have clients who have had DAFs running for 30 years? Yes, I have, but I don't know the exact rule of it.
John, do you know the rule on that? I don't. There are some limits.
There has to be.
But
I mean,
it's
they're not-
very
it's not a
small.
free-for-all.
I think you have to give a very small amount on a yearly basis. George, do you know this?
No, we've only been doing ours for a couple of years.
I'm pretty sure you do have to give a small amount each year to keep it active in essence, but to Scott's main point, you could keep money in a DAF for a number of years and spread it out over time.
Good question.
I do have a few more topics potentially, but we're getting close to the end of the hour here, so I want to just open it up and see if anything was top of mind for anyone that anyone wanted to cover.
Good afternoon. Just wondering, I'm thinking about qualifying for reinvest deductions. I understand there's some way that under certain circumstances, you can deduct for medical expenses that you pay for somebody else. Is that right or not?
The question is around deducting medical expenses that you might pay on behalf of another individual.
Right. I do not know the exact rule. I believe if they're your dependent, absolutely. What I do know is non-dependent, obviously. It's not, you're allowed to pay medical expenses. You get around the gifting rules, but whether or not it's deductible, I'd have to look deeper into that because it seems almost ripe to be manipulated in some degree. So I'd want to look into that.
So if I have an S corporation, and in 2022 I paid my estimates, but I didn't pay enough, so I still owe. So you're saying that I won't get penalized till October 15th?
It's S Corp tax?
Yeah.
Absolutely.
Real quick.
No, not S corp, that's already been filed.
Got it. It's your personal tax related to S Corp income.
Yes.
You have October 15th to make that payment.
So no penalty.
No penalty.
So again, the question was around S corps not having paid. Can you just repeat the question?
Yeah, so the question was if I essentially if I owe tax from my business related to my business income, can I pay it in October penalty free? And the answer is for 1 year, yes, you can. I mean, take advantage of it. Don't know when we'll see this one again.
It's very, very powerful.
Now,
Say, what about educational expenses for non-dependents?
Educational expenses for non-dependents.
So you can pay them. They're not deductible, right? Education in general has very limited deductions. Your AGI has to be low enough. The power of paying educational expenses for a non-dependent is the fact that it's not a gift to them, so you don't use up any gifting.
This is now related to estate tax.
Yeah, and it's not taxable to them. But to you personally, it's not a deduction.
We didn't really dive much into the estate tax realm, but that's a very powerful way to get money out of your estate, but not cross the thresholds of gift limits,
Yeah.
correct?
Yeah, and we can move. I mean, we can go to estate planning if
Yeah, maybe
that's
let's talk about that just really quickly. Just the concept of having a team of advisors and what that looks like. And I know so much of what you do is focus on income tax, but it's broader than that, right?
Absolutely.
And so maybe talk a little bit about that.
So, if you guys can walk away for one thing from today, it's that saving income tax is important, but the most powerful saving tool is the estate tax. Now today, it's almost $13 million a person. Okay, so a married couple's got $26 million exemption, meaning you can have that amount of wealth without paying estate tax. It's hugely high. It's not always going to be there. Technically, it's going to sunset in, I think, 2025 to $6 million a person. The amount of money that can be saved with proper estate planning is so much larger than what you'll save in the income taxes. And so when we talk about creating LLCs for AB 150, but piggybacking them with estate planning to get value to your next generation, that's huge. That's so much bigger. When you do estate planning in conjunction with your wealth advisor, in conjunction with your estate attorney, that's where you're creating potentially generational wealth for your family. And there's a lot of different strategies you can employ. But to just look at income tax and not see the estate tax as a whole is a misnomer. You want to look at them all in conjunction. You want to make sure your plan is not in favor of one and not the other, because ultimately you can get significant assets out of your estate at a discounted value to the next generation. And that in itself will dwarf 10, 20 years worth of income tax planning. And so I think it's really important when you talk about gifting, right? Right now it's $17,000 a year. You can give, one individual can give another one without eating into that exemption, that $13 million. And so you want to be taking advantage of those things if you're in that position, and that's something that's important to you. But between what educational funding, healthcare funding, the estate plan is really the most powerful, and it has a lot of what I call tools in its toolkit. There's a lot of different estate plans you can put into place. So as I mentioned earlier, it's really important that you work with your advisors with the estate plan in mind. And one thing that I really enjoy about the folks here at Morton is they have an estate planning attorney with them. They're very well versed in these things. And that, for most clients, is the most beneficial tool that they get out of having a team of advisors. As much as people come to me to do their income taxes, this is where I really think the value is at.
Are there other questions? Yep.
So your service, I mean, if we're working with a CPA that we've worked with for years and years and years, would you be part of a Morton team to look at a tax return and say, hey, you're missing this, you're missing that, or you should be considering this or that? Or would we just need to change CPAs?
The question is, if someone's working with a CPA other than Scott, what would it look like to potentially use Scott as a resource?
Great question. So clients will oftentimes hire me just to be a consultant, right? The beauty is I work with Morton so much that they'll have me look at things on behalf of clients that I will do sometimes real quickly just to assist. Other times they're like, hey, this client wants a review done. They'll bring me in to be that review arm. I can do that. There's no need to have me or my team doing the taxes. That's something that can be completely secondary. I can even guide the current person. I mean, being a CPA, there's different levels. People do different things. Our firm, and the reason we partner so well with Morton, is we want people to come to us for advice, not because, hey, I got to file my taxes. We're advisors. And so the part that makes me enjoy this job is doing the advisory. And so any way I can do that, whether or not I do the tax return, is irrelevant.
Okay.
So I found it's possible to, if you follow the current rules, you can show a capital gain, substantial capital gain for selling something today that you've owned for decades. That's really a capital loss because of inflation.
Okay, yeah.
Any way around this?
Can you repeat that?
Yeah,
There's
so
a line that says, what's the consumer price index
Yeah.
published by the government say
Yeah.
these dollars were really worth?
So the question is, if you report something in real dollars at a gain, but after taking into account inflation, it's truly a real loss, is there anything tax-wise that is impacted? And unfortunately, the answer is no. It's simply on a nominal 2 is bigger than 1 type transaction. Now, there's been ideas floated out there where you get your basis gets some type of CPI increase every year. Why those things sound good, I will tell you in practicality are very hard to pull off. No different, not a tangent here, but like this whole wealth tax concept, we're going to tax everybody on their wealth. You guys tell me, how would anybody value all your assets? I mean, how really are you going to do that? And so there's a lot of talk about indexing basis for inflation and for CPI. And I just think in practicality, those things to execute logistically are very complex. And so as of right now, those are ideas out there, but you're still stuck with your gain, unfortunately.
It's a great question, but I mean, just philosophically, the issues we have with this country, the necessity for tax revenues to support everything that's going on, we're likely in a high tax regime going forward as opposed to a low tax regime going forward. So proposals like that, while I think are very practical and reasonable, more than reasonable, fair, just probably wouldn't have much legs, if you will.
It's not a revenue raiser, unfortunately.
Exactly.
Sure. Care to speculate about what might happen in 2026?
Question on what can happen on 2026 when these laws sunset.
There's one really important thing that's going to happen between now and then. That's the 2024 election, right? And not telling you anything you probably don't know or haven't read or heard, but until we see what happens with the election, I think it's stalemate right now. My guess, nothing gets passed, right? You have you have a slightly divided Congress. Things are so close. I don't think any of these ideas out there right now are going to become law at this point, and it's going to really matter who has control of the legislative branches and obviously the White House come 24, because the ideas are very different. And the part that makes it so complicated is it's so hard to plan in this world of uncertainty. And this has been going on since 2018. It's just a constant back and forth and back and forth. And you just don't know how to plan. And so hedge your bets, talk to your advisors, have options, because we just don't know what the future holds. And that's one of the most frustrating and complex issues to cross.
Yeah, the 2026 unknowns are challenging. That being said, there are now recent proposals from the Biden administration with some pretty aggressive changes. And the truth is we probably even shouldn't spend too much time on them because, and we've talked about this quickly, we think it's unlikely, given again the nature of the split Congress, that these things will pass.
Right. Yeah, you do see things out there that are big fundamental changes in how we plan. They want to get rid of, 1031. That's near and dear to my heart. So I'm always looking at that one. That's one thing they want to possibly get rid of. They're talking about this wealth tax that I mentioned being a revenue raiser that way. They're talking about, we didn't touch on this, but I'll touch on this. S corps have a little bit of a special strategy to them. Income, whether it be from a W-2 or from a partnership, is subject to what's called self-employment tax, Medicare, Social Security taxes. Income you get on a K-1 from an S corp is not subject to that self-employment tax. And so oftentimes people put as much income as they can into their S corp, take as little a salary out of it. You have to take a salary, there are rules, but you try to minimize that to minimize your self-employment tax. Well, this rule or this proposal out there is that all S corp income is subject to self-employment. So you no longer need to plan, it's all subject to the same tax. That may have a little bit of legs to it, honestly, because it is a bit of a loophole, I will say that, but there's a reason for everything. One other thing I've heard, let's see, other topics that are out there. Wealth tax, 1031. Those are the biggies, I think.
Changing in tax brackets and rates.
Yeah, they want to go back to the 39% bracket, right? It's at 37, now it's going to 39. Yeah, that could be real money, but that's not something that's going to change how you plan. 2% is not going to change how you approach your planning. So I don't look at rate changes as being something that really has a heavy impact on the tax regime.
Any other questions before we wind it up? Good. Thank you, everyone. Really appreciate it. Thank you, Scott.
Thanks for having me.
Yeah, please reach out to your advisor. Scott's a resource as well, so don't hesitate if you have any follow-up questions. All right. Thanks, everyone.
Thanks, guys.